What if the UK housing market isn't just cooling, it's cracking? Not in a single headline, but in 1,000 small signals. Buyers freezing, sellers blinking, chains snapping, and a confidence game running on fumes. This is the turning point, and it starts quietly, before everyone hears the thud. Look beneath the averages, and you can feel the chill. Lenders talk of slight monthly upticks and year-on-year stability. But the story on the ground is different. Viewings stretch out, offers slip, and the old autumn bounce refuses to show. Across the country, buyers are sitting on the sidelines, waiting for the chancellor's next move. Talk of property taxes above £500,000 is enough to slow the high end, and when top-end deals stall, entire chains down the ladder move in slow motion. Even after Bank of England cuts, borrowing costs remain far above the pre-COVID era. Stability at altitude is still altitude, and thin air makes everyone cautious. A market doesn't crash the day prices print red. It crashes when behavior shifts, when sellers cut quietly, when fall-throughs creep up, when "we'll wait for the budget" becomes the default strategy. That's where the UK stands, a stalemate built on hesitation, with sentiment doing more work than spreadsheets. Affordability is the fulcrum. Mortgage rates that more than doubled versus 5 years ago rewired household budgets. Repayments that worked at 2% don't work at 5%. Even if the next move in rates is down, today's stress tests and income realities keep leverage honest. Approvals tick over, but only for buyers who can clear the new bar, so the market holds until it doesn't. Policy now sits in every living room. A potential levy on higher value sales changes the maths on deposits, stamp duty, and timelines overnight. If it lands, top-end pricing must re-underwrite. If it's shelved, a relief bid appears, but only until the next macro wobble. Late cycle markets don't sprint, they shuffle. Listings arrive, portals show activity. Yet an unmistakable tell is the absence of frothy asking price jumps. Sellers who lead on price clear. Sellers who follow the old comps stack up. The negotiation gap widens. Best in class, at the new number, beats testing the last peak every time. Abroad, one red flag is already flashing. Buyers chasing lower headline rates with riskier adjustable loans, betting they'll refinance later. Standards may be tighter now, caps stricter, but the pattern is familiar. When affordability bites, markets hunt for relief in structure rather than price. The UK's guardrails are sturdier, but the lesson stands. When money stays expensive, pressure migrates to the edges, and those edges flex first. Don't picture a cinematic plunge. Picture a grind. Longer days on market, more conditional offers, bigger chains, tougher surveys, and a rising premium on certainty. Vendors who accept the new reality transact. Vendors who trade anecdotes for evidence watch the clock. Economists describe recent patterns as broad stability, true and deceptive. Stability with borrowing costs still high isn't the old normal. It's a balance beam. Mortgage approvals may resemble pre-pandemic rhythms, but consumer confidence is subdued and the labor backdrop is softening. The floor is thinner, the ceiling lower, and direction rests on policy, pay growth, and nerve. Speed beats pride. Price ahead of the curve, not behind it. Fix small defects that stall surveys. Remove frictions that spook chains. Become the listing that looks obvious at first click. In thin air markets, liquidity is king, and time is its tax. Patience, not panic, is the buyer's edge. Underwrite total cost of ownership, rate, energy efficiency, service charges, maintenance, insurance, not just the monthly payment. Know your comps. Know your ceiling. Let volatility work for you. Stretching to the last pound for the wrong asset is the most expensive move you can make. Landlords are facing the toughest climate in a decade. Higher funding costs and stricter affordability tests pinch yields. Void periods matter again. Energy upgrades, tenant quality, and proactive maintenance now separate steady income from slow erosion. The easy years of buy anything and it lets itself are over. Operations decide outcomes. Margins are thin, regulation heavier, and renters far more discerning. Those who adapt will survive, those who coast will vanish. Late cycle deals are brittle. Tiny survey findings trigger big renegotiations. A small rate blip derails a chain. Even when the official index inches up, the lived reality is a market that feels heavier, slower, and more conditional. Proof that averages lag reality. The industry feels like it's balancing on glass. Strong looking, but one wrong step away from fracture. To steady this market, three forces must align. A clearer tax path, income growth that finally beats inflation, and meaningful cuts in borrowing costs. Each would lift a corner of the pressure, but margins aren't momentum. Momentum is what drives optimism, and without optimism, gravity does the work. For years, the UK housing narrative was simple. Buy now, be glad later. That story no longer sells. Today, the script has changed to prove it. Prove your income. Prove your valuation. Prove your buyer's chain won't collapse. The longer buyers wait, the more sellers are forced to re-anchor expectations, and the more the numbers reveal what the sentiment has already known for months. And behind every percentage point are human stories. The young couple delaying their first home, the landlord offloading after a decade of steady gains, the family priced out of their own neighborhood, the pensioner watching equity shrink on paper while bills rise in real life. These aren't statistics, they're signals. The crash, this time, won't look like a single moment of chaos. It's happening right now, in slow motion. In the whispers between agents, the hesitations on the phone, the price reductions that don't make headlines. It's a crisis of confidence wrapped in polite language. Not a collapse in bricks, but in belief. And yet, where there's collapse, there's opportunity. Cash buyers gain leverage. First-time buyers with patience may find entry points unseen in years. Developers willing to shift product type, smaller, greener, denser, can capture unmet demand. Crashes don't end markets, they reset them. The question is, who's ready for the reset? This moment is also political. Housing isn't just an economic metric, it's a vote. The next budget, the next policy tweak, the next promise of affordability. Each is a signal to millions watching their futures shrink or expand with every percentage point of interest. The government knows this market is more than a number. It's the foundation of confidence itself. The reality? The UK property market has been living on borrowed time and borrowed money. Every cycle tells the same story. Easy credit, inflated prices, and then the reckoning. What's different this time is that people see it coming. There's no shock left, just fatigue. This is how a modern crash looks in slow motion. Not panic, but persistence. Not a cliff, but a slope. Not a single day, but a season of second thoughts. If you're selling, speed and realism win. If you're buying, discipline and patience win. If you're holding, cash flow and resilience win. We'll track the budget, the next Bank of England move, approvals, fall-throughs, and the pricing tells that never make headlines. Subscribe, like, and turn on notifications if you want the next update the moment it drops. Because in a market held up by confidence, information isn't just power, it's protection. The UK real estate market is calm in the averages, tense in the trenches, and one decision away from a very different story. Stay sharp, stay liquid. Don't mistake quiet prices for a quiet market. This is the pivot. Act like it.